The S&P 500 is currently at an all-time high in terms of price, but if we look at the valuation, it is also almost at an all-time high, currently at 40.9 if we look at the Shiller PE ratio, which is almost the same level we got in the dot-com bubble at 43. So it's getting harder to find real value in the stock market, but there is still value, and today I'm going to rank the most famous YouTube stocks to determine whether or not they are a buy. And let's start with Meta, which I actually recommended buying when it was under $150 per share. I also made a video saying I was selling it at around $700 per share, which got some hate. So today, the stock is down around 20% from its all-time high, so let's see if the stock is a buy. They are selling at a forward P of 22, and analysts have them as a strong buy with 26% upside. It is a $1.6 trillion market cap, so we also have to wonder how much upside this company still has. Now, if we look at the financial, their revenue has grown very nicely from $17 billion to $189 in the past 10 years. And if we take a look at their profit, net income has also seen very good growth from $3 billion to $58 currently. They have a little bit less free cash flow, currently at $44 billion. And their margins are amazing because gross margin is around 82%, profit margin currently at 30%, and free cash flow margin a bit lower at 23%, although it has been around 30% in the past decade. Now, if we take a look at analyst forecast, they are expecting a lot of growth to continue, as they have Meta reaching $203 billion this year and grow to $404 billion by 2030. Which is around a compounded annual growth rate of 14%. Regarding profit or EPS, analysts have them also growing at around double digit for the next 5 years, which is great. And if we take a look at some other important statistics, we have already seen that the market cap is very large at $1.6 trillion and the balance sheet is amazing. They have $44 billion in cash and $51 billion in debt. So again, this is nothing for a company of $1.6 trillion. Now, some other important valuation ratios that we have already seen is that the forward P is 22 and the price to free cash flow obviously a bit higher because they have less free cash flow, currently at 36. Now, if we take a look at some important metrics of this company, they are growing everywhere. As you can see, the average revenue per user is growing, family daily active users is growing. If we take a look at revenue by segment, they are growing in advertisement, Reality Labs, which is the metaverse, and payments and others. So I think it's clear that the fundamentals are amazing. This leaves us with the question, can we pay a reasonable price in order to make a good return on your money? This is why I'm going to use a discounted cash flow model. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. With every company that you're going to see on this video, I'm going to do a 7-year analysis as a long-term value investor with low, middle, and high assumptions, kind of to get a range. And as you can see, the intrinsic value of, according to my low assumptions, is $424 per share, middle $630, and high $912, and the stock is currently trading at $653 per share. This also means that if my low assumptions occur, you would get a 2.7% annual return on your money, middle 9.4%, and high 16%. So I would say Meta is trading at around fair value, which is why I would rank Meta as a B tier to buy right now at current prices and based on current valuation. Now let's take a look at Adobe, a stock that has been struggling in the past 5 years, down 31%. However, analysts have them ranked as a buy and the price target is 26%. They are currently trading at a forward P of 14. So why is the stock down so much? Well, it's because of fears that AI will take over Adobe. I've done videos on my channel how I believe that won't happen, and in fact, if we take a look at the fundamentals, the revenue has grown from $5 billion to $23 billion in the past decade, so very consistent growth. Their profit has also grown from $1 billion to $7 billion, and they have even more free cash flow, currently at $7.8 billion. Now, another thing Adobe is doing right is buying back shares. This is fantastic for investors because you own more of the company and share the profits with less people. So this is going to drive earnings per share massively. And as you can see, the cheaper the stock has gotten, the more shares they've bought, which is amazing. If we take a look at their margins, gross margin being at 89%, profit margin at 30%, and free cash flow margin currently at 36%, although they've hit peaks of 43%. Now let's take a look at the forecast and see what analysts are expecting. As you can see, as far as revenue, they are expecting Adobe to go from $26 billion to $35 billion in the next 5 years, so still a lot of growth expected in terms of revenue, but also in terms of profit, from $23 per share and 96 cents to $33.60 per share. They also have an amazing balance sheet as they have $6 billion in cash and $6 billion in debt, so they have the same amount of cash than debt. And another very important statistic is the return on invested capital, and they have 28%, which is amazing and means that the company does a fantastic job reinvesting the money in the business. So the fundamentals look amazing. The company is expected to keep growing. So now the question is, can we pay a good price? Well, as you can see, it looks very discounted on the valuation spreadsheet, as they have intrinsic value of 355 according to my low assumptions, middle 470 and high 613, and the stock is currently trading at $334 per share. This also means that if my low assumptions occur, you would get an 11.2% annual return on your money, middle 16.35 and high 21.45. We have the company growing revenue between 6 and 10% annually for the next 7 years, averaging a profit margin and free cash flow margin between 32 and 38%, which is what they have been doing. And I assigned the PM price to free cash flow at the end of the 7 years of 18, 20, and 22. But if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. Super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. And if you're watching this video, the day it goes live, I'm going to put the spreadsheet at just $1, so take advantage of that. Conclusion: Adobe is a company that is growing fundamentals, and the stock price looks very cheap. Therefore, I'm going to put this as A tier. Now let's take a look at Palantir, a company that has exploded, especially in the past couple of years. Now the stock is trading at $177 per share, and I remember doing videos when the stock was under $10 per share, saying it was a good buy. But let's see if it's still a good buy today. Analysts have them rated as a hold with a price target of $174 per share. The market cap is now $423 billion. And this is a company that is generating in revenue $3.9 billion. And as you can see, it has exploded, especially in the past 2 years. This year alone, revenue grew 47%, which is insane. Now their profit has also started to explode, and they are now generating $1 billion in net income. As you can see, this company used to be unprofitable. Now, one thing that I like is that they have a lot more free cash flow, currently at $1.7 billion. On the other hand, one thing that I've never liked about Palantir is that they are diluting shareholders. As you can see, they haven't stopped increasing the number of shares outstanding. This is horrible for investors because you share the profits with more people and you own less of the company. And as you can see, they have been diluting shareholders by a lot. Now this company also has amazing margins, gross margin being at around 80%, profit margin around 28%, and free cash flow margin at around 46%. Analysts are expecting insane revenue growth in the next 5 years, as you can see, from $4.4 billion to $22 billion, which is around 35% compounded annual revenue growth, and profit from 74 cents per share to $3.29 per share. So revenue and profit growth is expected to be insane. And this is a company that also has an exceptional balance sheet. I mean, they have basically no debt, $200 million, and $6 billion in cash. Now, the issue with Palantir that I have right now is the valuation. As you can see, the trailing PE is 386. The price to sales is 107. And the price to free cash flow is 235. Take a look at the discounted cash flow model. The stock just looks insanely overpriced. I have intrinsic value of 25 according to my low assumptions, middle 61 and high 135. And I believe I made insane assumptions from my high. I have 40% annual revenue growth and profit margin and free cash flow margin of 55%, which they haven't even done. I mean, this company should have to grow at around 50% annually, which is insane, for it to justify its current valuation. So I just think there is a lot priced in for the company at the moment. And because of the valuation, I'm going to rank it as D tier at current prices as an investment. Next up, we have MasterCard. 62% in the past 5 years that analysts have rated as a strong buy, with price target of 652, which is 13% upside. The market cap is $516 billion, and they are currently trading at a PE of 36, which looks a bit expensive. However, I believe this company deserves a premium because it is fantastic. I would love to own this company because I believe it's the ultimate moat, and their revenue has grown very consistently from $9 billion to $31 billion. It only decreased but during COVID, so I think we cannot take that into account. Then their profit has also grown very nicely. Net income, as you can see, from $3.8 billion to $14.2 billion today, and they have even more free cash flow, again consistent growth to $17 billion. They have also been buying back a ton of shares consistently, which again, as I've said before, is very good for investors. Now, if we take a look at the forecast, analysts are still expecting this consistent growth both in profit and revenue to continue in the upcoming years. So the only question that remains is what price is good price for MasterCard. And as you can see, according to my assumptions, the stock is worth between $354 per share and $624, and the current stock price is $576 per share. So I think it's trading at around fair value, which is why I'm going to put MasterCard at B tier like Meta. Is PayPal another payment processor like MasterCard? Now, sentiment around PayPal has been horrible. As you can see, the stock is down 76% in the past 5 years. They have a market cap of $53 billion and analysts have them rated as a hold. So sentiment is horrible. However, if we take a look at the financials, the revenue has not stopped growing from $9 billion to $32 billion in the past 10 years. Yes, revenue growth has slowed down a bit in the past year. However, if we move to quarterly, you can see that last quarter they grew 7%, which is nice. If we then go to their profit, it also hasn't stopped growing from $1.2 billion to $4.9 in net income. Again, we have a company that has even more free cash flow from $1.8 billion to $5.5 billion. And again, we have a company that has been buying back a ton of shares, especially as the stock has gotten cheaper, which again is amazing for investors. And I mean, in the past couple of years, they've bought back 6% of their shares. They also have very good margins with gross margin at 40%, profit margin at around 15%, and free cash flow margin again a bit higher at 16.9%. So let's see what analysts are expecting. Analysts are still expecting growth both in revenue and in profit. So does this look like a dead company to you? Yes, it's not going to grow double-digit percentages in terms of revenue, but growth is still growth. And the reason why I believe this stock is amazing to buy right now is because of the valuation. As you can see, I have intrinsic value of 76 according to my low assumptions, middle 95 and high 118, and the stock is currently trading at $58 per share, which means that if my low assumptions occur, you would get a 15% annual return on your money, middle 20% and high 24.5%, which are amazing returns, meaning you would beat the market with my low assumptions, which I believe are extremely conservative because I have the company growing revenue at 4.5%, profit margin of 14%, and a PE of 15. And I didn't even assume any share buybacks, as you can see. So if we go back to our intrinsic value of 10%, the reason why I put 10% for intrinsic value is because that's what the market usually gives you. So if you decide to invest in an individual stock, you should desire a higher return. And if we put they buy back 2% of their shares annually for the next 7 years, which remember they've been buying back 6%, so I don't think this is out of the world. As you can see, the intrinsic value becomes even more insane, which is why for me PayPal is probably the best stock to buy in the stock market at the moment in terms of risk reward. Although some of these companies are growing revenue and profit faster than PayPal, the valuation is nowhere near. And remember that in the long term, you need a company with good fundamentals, which PayPal has, but most importantly, that the valuation is very cheap, which is why I have it at S tier. Now let's take a look at Duolingo. Duolingo is a company that has been struggling this year, and similarly to Adobe, the reason for this is because people also fear that AI will take over Duolingo. If we take a look at their financials, their revenue has seen very good growth, growing from $70 million to $964 currently. And the past couple of years, they've grown at 40%, which is insane. Now, their profit has also grown very consistently. It used to be an unprofitable company a couple of years ago, but they are now generating $386 million in profit. Now, in terms of free cash flow, It is very similar and they are generating 354 million. This is a company that has been issuing shares, which I don't like. However, it seems that they are decreasing the number of shares they are issuing. Now, because this is a software company, their margins are great. 71% gross margin, profit margin at 40%, and free cash flow margin at around 36%. If we take a look at what analysts are expecting, there is a bit of unknown about Duolingo. For example, they have revenue growing to $1 billion this year and then to 1.7. However, if we take a look at profit, it is expected to jump this year to $7.78 per share, but then decrease to $5.50 per share. Now, according to my intrinsic value calculator, I think Duolingo is trading around fair value. I have $122 per share according to my low, middle 176 and high 249, and the stock price is 177. So I mean just around my middle assumptions, which is why I think it is spot on around fair value. Now the issue I have with Duolingo is that I think there is a lot of unknown about the future of this company. I mean, I think it is very hard to predict what the future growth is going to be, which is why I'm going to put it at C tier, because when you're valuing stocks, it is very important that you're confident in your assumptions. For example, with PayPal, I assume 4.5% annual revenue growth, which I think that is very probable. Now with Duolingo, I don't know if they're going to grow at 5%, 10%, or even 20% per year, which is why I'm going to put them at C tier. Now let's take a look at Uber. The stock is up 31% in the past year, and analysts have them ranked as a strong buy with 27% upside. Now Bill Ackman, as you know, a very famous investor, has bought Uber in the past year. And if we take a look at their fundamentals, they are truly amazing. Revenue from $3.8 billion to $49 billion. Net income, as you can see, from negative and now at $16 billion. This company used to be unprofitable because they were reinvesting all that money in growth. But also, as you can see, free cash flow, something that I don't really like about Uber, is that free cash flow is basically half as net income, currently at $8 billion. And they have great margins, gross margin 34%, profit margin 33%, and free cash flow margin, as we have seen, 17%. Take a look at the financial forecast. Analysts are expecting revenue to grow very consistently from $53 billion to $92 billion by 2030. However, something very weird is that they actually have profit decrease from $5.36 per share to $3.24 per share. So I actually do not agree with analysts on this take, and I think profit will continue to grow. Now this company has also an amazing balance sheet with $9 billion in cash and $13 billion in debt, which is manageable for a company that has a market cap of $177 billion. And what's actually very interesting about Uber now is the valuation. The current P is 10, the 4P is 25 because profit is expected to decrease next year, and the price to free cash flow is 20, which are fair multiples for a company that has this amount of growth. If we take a look at some metrics about the company, if we take a look at revenue by segment, Uber is growing very nicely in all categories: mobility, delivery, and freight. And also, if we take a look at the revenue by geography, they are growing in every part of the world: US and Canada, Europe, Middle East and Africa, Asia Pacific, and Latin America. So I think there is a lot of upside in some underdeveloped areas. Now, if we take a look at the intrinsic value calculator, Uber looks very good. We have returns of 9.3% according to my low assumptions, middle 18.5%, and high 27.5%. So it looks like it is clearly undervalued. And if we put our intrinsic value of 10%, we can also see that I have intrinsic value of $82 per share, middle 134, and high 208. So it looks very good. The only issue with Uber is competition, as a lot of companies are starting to compete with Uber, especially in the US. But Uber, honestly, because of the valuation and fundamentals, I'm going to put it at A tier, just behind Adobe. Now let's take a look at Tesla. By the way, where I'm showing all the data is stockanalysis.com. In my opinion, this is the best place when you can get stock data. They have up to 10 years of financial historical performance. They also have forecasts, statistics, metrics, dividends. They have literally everything. They also have tons of other tools. I mean, you have a segment dedicated to IPOs when you can see the calendar, recent IPOs, ETFs as well, screener comparison tool. You have a news segment, which is very good. You have the trending stocks, you have articles. You can also do technical charts if you are into that. I mean, it's truly an amazing page, and you can use my discount code in the description. They also have a completely free market newsletter, which you can stay informed in just 2 minutes, and I'm going to leave a pinned comment below as well. Which is one of the largest companies in the world with a market cap of $1.4 trillion, and last year they generated $95 billion in revenue. And if we take a look at their revenue, it took a big jump from 2015 to 2023. However, since then they have been struggling, and revenue has even decreased a bit in the past couple of years. If we take a look at their profit, they are currently making $5 billion, and profit has dropped from $14 billion making in 2023. So this is a company that has been struggling. And as you can see, free cash flow is a bit better, currently at $6 billion. So there is a debate on whether Tesla is a car company or not. And honestly, their margins look like a car company because profit margin is around 5% and free cash flow margin currently at 7%. And some people believe Tesla is a software company. However, we have seen other software companies in this video, and their profit margin and free cash flow margin is more around 30%. Now, as far as analyst expectations, they are expecting Tesla to go from $97 billion to $259 billion, and from $1.65 per share to $11.57 per share. So huge growth according to analysts. If we take a look at the revenue by segment, we can see that the auto part of the business has been struggling, and revenue has even been decreasing. Now, the bullish case for Tesla is that these two sectors are going to grow, which is true that they have a lot higher margins. As you can see, services and others are growing at around 20% per year, and energy and storage are around 40%, which is huge. But currently they are making between the two of them $24 billion, and the auto sector $71 billion. So if we go to the discounted cash flow, as you can see, Tesla looks heavily overpriced. I have intrinsic value according to my high assumptions of 150, and I assume margins of 15%, because remember they are currently doing 7%. So they would have to grow at around 30% or so per year, even more than 30%, to justify today's price, which is why I think Tesla is heavily overvalued, and there is a lot priced in for the company. It should become a software company in order to justify the current numbers, which is not. So I'm going to put it at D tier with Palantir. Let's take a look at Google. Performed incredibly well over the past 5 years, up 265%, and especially in the past year, up almost 70%. However, if we take a look at the chart, Google was under $100 per share a couple of years ago, which I also made videos saying it was trading at a very good valuation. Now, the reason at that time was because AI was going to hurt Google, which is the story we are seeing today with other companies such as Adobe. So I think maybe we're going to see the same with companies like Adobe. And Google's fundamentals haven't stopped growing. As you can see, from $74 billion to $385 billion today, and profit as well. For example, net income from $16 billion to $124 today. However, they have less free cash flow, currently at $73 billion. Google's fundamentals are amazing. They are also buying back a few shares, which I actually prefer when the company is trading cheap and not expensive like we're going to see right now. And also, if we take a look at the forecast, analysts are expecting this amazing growth to continue. Double-digit revenue growth for the next 5 years, and basically double-digit growth in profit as well. Profit is actually expected to double from $10.90 per share this year to $20.68 per share in 2030. They've also added a dividend recently. It is very small as the yield is 0.26%. I actually prefer when companies like Google that still have a lot of room for growth don't pay that dividend and use that money to reinvest in the business. Now, if we take a look at some statistics, the balance sheet is amazing. $98 billion in cash and $44 billion in debt. And let's take a look at the valuation. The 4P is 30 and the price to free cash flow is a lot higher at 47. So let's see how it plays out in the discounted cash flow. Well, it looks a bit expensive at current prices. As you can see, I have intrinsic value according to my high assumptions of 347 and the stock is at 329. So it would only be a buy according to my high assumptions. I believe Google is a fantastic company with amazing fundamentals, just a bit expensive at current prices. So I would buy the company, but maybe under $200 per share. This is why I'm gonna put it in B tier like Meta and MasterCard. Now let's take a look at Netflix, which is up 75% in the past 5 years. However, the stock is down from its all-time high about 20% or more. This is because there are some uncertainties about the recent acquisition of Netflix and Warner Bros. Discoveries. Now, if Netflix acquire Warner Bros., they would have HBO. Netflix is currently the #1 streaming platform and HBO the fourth. And honestly, I do think that there are a lot of competition in the streaming platform, but Netflix does definitely have a moat. And if we take a look at their financials, their revenue growth has been amazing and very consistent, from $6 billion to $43 billion. If we take a look at their profit, net income from $122 million to $10 billion, and free cash flow currently at $8 billion. They also have fantastic margins, with profit margin and free cash flow margin being between 20 and 24%. And analysts are expecting a lot of growth, both in terms of revenue and in terms of profit for the next 5 years. So Netflix fundamentals, I also believe, are going to keep getting better and better. The issue I have with Netflix is the valuation. As you can see, it looks expensive in the intrinsic value calculator, and on my high assumptions, I assume 12% annual revenue growth, a profit margin and free cash flow margin of 26%, and I assigned the PM price to free cash flow at the end of the 7 years of 22. So although Netflix, I believe, has a moat, has great fundamentals, the company is going to keep growing and growing. I just think the valuation is not very attractive at the moment, which is why I'm going to put it at C tier. Take a look at Amazon, again one of the largest companies in the world with a market cap of $2.6 trillion, and they did $691 billion in revenue, which is insane. Analysts have them ranked as a strong buy with 15% upside, and if we take a look at the chart, the company has exploded since it was around $86 per share, and now it is at $247. Again, their fundamentals are amazing. As you can see, very consistent double-digit revenue growth. And if we take a look at their profit, it has improved massively, and they are currently making $76 billion in net income. And if we take a look at their margins, they have also improved massively, and they are now making 11% profit margin, which is really good. One thing that I don't really like is that they have less free cash flow. As you can see, it is currently $10 billion, but this is because they are spending all their money reinvesting in the business, such as warehouses, robotics, etc. And free cash flow margin is currently at 1%. If we take a look at analyst forecast, again, they are expecting this consistent revenue and profit growth to continue, double-digit revenue growth, and reach $1.23 trillion in revenue, which is insane. And as far as profit, from $7.28 per share this year to $70.69 per share, so double-digit profit growth. Now, if we take a look at the balance sheet, it is really good as well, with $94 billion in cash and $160 billion in debt. Now, as far as the valuation, P of 34, forward P of 33, and price to free cash flow of 250. But this is because, as we have seen, they are spending a lot of money, so I wouldn't worry that much about this number. Now, as far as the valuation goes in the discounted cash flow model, Amazon looks again like it's trading around fair value. I have low value of $77 per share, middle 163, and high 276. Now, I believe my assumptions are reasonable. I have revenue between 8 and 13%, profit margin and free cash flow margin between 5 and 11%, although I think you could argue this could be higher in the future because they also have AWS, which is a high margin business. And I also assigned the PM price to free cash flow at the end of the 7 years of 20, 23, and 26. So again, Amazon, great fundamentals, great growth ahead, decent valuation, so I would put it again at B tier. Now the last stock that we're going to see is Salesforce, which has a market cap of $243 billion, and they generated $40 billion in revenue and $7 billion in net income. Analysts have them as a buy with a current price target of 24%. Now last year they've been struggling, down 20%. They also pay us very small dividend of $1.66 per share. And this company sells software to big companies such as CVS or Costco. They have seen amazing revenue growth, to be honest, from $6 billion to 40, and their revenue is very consistent because I believe it is very sticky. Now, if we take a look at their profit, again, because it's a software business, they have very good margins. Gross margin at 77%, profit margin at 17%, and free cash flow margin at around 31%. And they've also been buying back a few shares now that the stock is cheaper, which is something that I really like. They also have very good free cash flow growth, currently at $12 billion. But if we take a look at the spreadsheet, the company looks like it's trading around fair value. According to my middle assumptions, you would get returns of 9.1%, and it is why I'm going to rank Salesforce at B tier, but the first one in B tier, because I believe the valuation is the most attractive out of these 5. And just in conclusion, I would say be careful with some YouTube stocks such as Palantir and Tesla, because they are very overpriced at the moment, and this can hurt your returns massively in the future. Remember that valuation is mostly what drives a company in the long run. Then Netflix, I believe, is a bit expensive, and Duolingo is just in a weird place right now. I think there's a lot of unknown about the company. These 5 companies are trading around fair value, although I think the most discounted is Salesforce. Then Adobe and Uber I will rank as a buy, although I don't currently own. I'm considering Adobe, and what I'm doing with Adobe is selling put options, which is complicated, but I will explain later. And the company that I do own that I think is a great buy at the moment is PayPal, just because of the risk reward I think is very, very attractive. So I hope you found this video valuable. Let me know what you think about these companies in the comments, and I'll see you in the next one.